Your parents ever told you the most financially responsible thing you could do is put money in your 401k? Max it out every salary. It doesn't matter, and that counsel was a religion for 30 years, basically. You don't even ask. You don't look at it. You just do it the same way you put on a seatbelt or brush your teeth, because a responsible adult told you to do it once, and you never looked back at the logic. Every January, meanwhile, you get a statement in the mail that you look at for about 4 seconds, see a number that feels vaguely positive, nod to yourself like a man inspecting drywall you can't understand, and toss it in a drawer. You don't even know what you're paying in fees. You don't know what funds you're in. You have no idea the IRS is quietly building up a tax bill in that account that's going to explode the month you turn 73. But hey, you're a responsible person. You emptied your 401k. Congratulations! You followed the directions on the box. The box was made by the people who sell the box. My name's Scott, and today I'm going to take apart the most expensive lie ever sold to you by the financial industry. Your 401k is the right place for every dollar of retirement savings after age 45. Well, it's not. Not in the ballpark, even. And the math is going to make a lot of people who thought they were doing everything right very, very uncomfortable. Let me be crystal clear about something before we start, because I can already hear the comments. I'm not saying the 401k is bad. I'm telling you the 401k has a specific narrow use case that's extremely valuable, and all else is a trap dressed up as a benefit. The employer match is money for free. Always get it. Always. If your employer matches half of the first 6% of your pay, put in 6%. That's an instant 50% return on your money before the market moves one way or the other. There's no investment on earth that promises you a 50% return on day one. Take the match. But the moment you leave the game, you need to know what you're actually doing. Because what you're actually doing is volunteering to a system that limits your investment choices, charges you fees you can't see, locks your money behind a penalty wall until you're 59 and a half, and then makes you take it out on the government's timetable whether you need it or not, at a tax rate you have no say over. That's not a retirement strategy. This is a financial product with a lock-in period of 30 years and compulsory exit fee. And the only reason no one told you this is because the people administering your 401k make money every single year your balance stays in the system. Let's begin with the bit that should really scare you. The charges. According to the Investment Company Institute, the average expense ratio on 401k equity mutual funds is about 0.26%. That doesn't sound like much. That sounds like a rounding error. But this is what the Department of Labor found when they did the real math. A 1% difference in fees can reduce your total account balance by about 28% over 35 years. Let me repeat that. 1%. 28% of your money. Gone. Not to the marketplace. Not taxes. From the company that runs your plan. The Center for American Progress found that many 401k plans, particularly smaller ones with fewer than 100 participants, have all-in fees of 1.32% once you sum up the investment expense ratios, the administrative costs, and the record-keeping charges. Your employer selected this plan. These fees were negotiated by your employer. And in most cases, your employer has no financial incentive to negotiate them lower, because your employer isn't paying the bill. Let's be specific here. So if you have $200,000 in your 401k and you're contributing $10,000 a year, and you're paying 1.32% in total fees versus someone in a Roth IRA paying 0.03% on a Vanguard S&P 500 ETF, over 30 years at 7% average returns, that fee difference costs you roughly $469,000. That isn't a rounding error. That's a house. That's a decade of retirement income. That's the difference between retiring at 62 and retiring at 70. And you never saw it go because the fee was taken out of your returns before the number ever showed up on your statement. You didn't even know the money was there before it was gone. But those fees are layer 1. Let me show you the second layer. Your 401k comes with a menu. Most 401k plans have 8 to 30 investment options, picked by your employer and the plan administrator. You didn't pick these funds. You didn't evaluate those funds. They're picked by someone in HR or a third-party benefits consultant. In many cases, they're picked because those funds have a revenue-sharing arrangement with the plan provider. That means the fund company is paying the administrator a share of the action. Guess where that cut originated? Your returns. Meanwhile, if you opened a Roth IRA at Fidelity, Vanguard, or Schwab, you'd have access to thousands of individual stocks, bonds, ETFs, and mutual funds. The whole market. All sectors. Every method. All price points. Your 401k is like a kid's menu. Your IRA is the entire restaurant, and you're paying more for the kids' menu Now let's talk about layer 3. This is the one that totally catches people off guard after 45. The tax time bomb. Contributing to a traditional 401k gives you a tax deduction now. Your taxable income is reduced. You pay less taxes today. That feels good. It's kind of a win, but that's not what they tell you at the enrollment meeting. You didn't escape the taxes. You held them up. Every dollar in that account, and every dollar of growth it ever generates, will be taxed as ordinary income when you take it out. Not the capital gains rates. Rates of ordinary income. The same rate as you pay on your salary. And this is where it gets really insidious for people over 45. You're 45, statistically, in or near your peak earning years. Chances are you're in the 22 or 24% federal bracket, maybe even more. So the tax deduction you're getting today is saving you 22 to 24 cents on the dollar that you put in. Awesome. But once you retire and start pulling money out of that 401k, especially when the required minimum distributions start, there's no guarantee you'll be in a lower bracket. In fact, the math predicts a lot of people will be in a higher one. Here is the cascade. The IRS requires you to begin withdrawing money from your traditional 401k and traditional IRA when you turn 73, or 75 if you were born in 1960 or later, even if you don't want to. These are called required minimum distributions, and they're, well, required. Miss one and the penalty is 25% of the amount you were meant to withdraw. The IRS doesn't want to hear. They're telling you to pull your money out, pay taxes on it, and do it on their schedule. And that's where the cascade becomes a financial avalanche. Those RMD withdrawals are taxed as ordinary income. That income can bump you into a higher tax bracket. That additional income also triggers something most people don't learn about until it's too late. If your total income is over $34,000 for a single filer, or $44,000 for joint filers, up to 85% of your Social Security benefits are taxable. Your 401k withdrawals literally make your Social Security be taxed. Two streams of retirement income that are cannibalizing each other. But wait, it gets even stupider. Medicare has a thing called IRMAA, which is Income-Related Monthly Adjustment Amount. In 2025, the standard monthly premium for Medicare Part B is $185. But if your income, bloated by those forced 401k withdrawals, is over $106,000 as a single filer, your Part B premium jumps to $259 a month. If you make over $500,000, it goes up to $628.90 a month. Your 401k isn't just being taxed, it's driving up your healthcare costs. The system you thought was protecting your retirement is actually costing you your retirement. Let me present to you the Mitchells. Greg Mitchell is 47. He is a senior project manager for a mid-sized engineering firm in Columbus, Ohio. His wife Laura is 45 and works part-time as an occupational therapist. 172 grand combined household income. By any reasonable standard, they're doing well. All is better than all. They earn enough to put them in the top 25% of households in America. They were right all along. Greg has been putting in the maximum amount into his 401k for 19 years. His balance just hit $420,000. Laura has a 403b from a prior full-time job worth approximately $85,000 and a small Roth IRA worth $18,000. Total retirement savings about $523,000. Greg's 401k is managed by a mid-tier provider. There are 22 fund options in the plan. Greg's enrollment form was confusing, and the target date fund was advertised as a set-it-and-forget-it solution. So his plan enrolled him in a target date fund, the default option. That target date fund has an expense ratio of 0.46%, and the plan charges an annual administrative fee of 0.3% of assets. Greg's total cost is 0.76% per annum on $420,000. That's $3,192 a year in fees. Greg has no clue he's paying this. He's never seen a line item on his statement that says $3,192 because the fees are taken out of his returns. They're supposed to be invisible. Now, let's get ahead. Greg is 47 years old. He is retiring at 65. That's another 18 years of contributions and growth. If Greg keeps maxing out his 401k at $23,500 per year, and his employer kicks in about 4% of his salary, or about $4,500, and the portfolio grows at 7% after inflation, Greg's 401k will be worth about $1.6 million at age 65. Sounds good. This number will do for Greg. $1,600,000. He'll be fine. Except he isn't. $1.6 million in a typical 401k isn't $1.6 million. It's $1.6 million less what the IRS decides to take, and the IRS is going to get a lot of it. When Greg is 75, his required minimum distributions will be about $63,000 a year. That number goes up every year because the IRS divisor table shortens as you age. By 80, it's more like 78 grand. By 85, more than 95,000. Every year, required, and each dollar of it's taxed as ordinary income. Add Greg's Social Security, which will conservatively estimate at $28,000 a year, and Greg's annual taxable income in retirement is over $90,000. He is retired now, in the 22% federal bracket. He deferred taxes in the 22% tax bracket at age 47 to pay taxes in the 22% tax bracket at 75. The delay was of no advantage to him, and if rates rise in the meantime, as virtually every economist expects given the trajectory of the federal debt, he actually paid more. Meanwhile, Greg's Social Security is now 85% taxable, his combined income way over the $44,000 limit. And his Medicare Part B premium is $259 a month instead of $185 because his income went over the IRMDA cutoff. Because the government is forcing Greg to withdraw money from an account he was told would save him taxes, his Medicare premiums have increased by $1,000 a year. The 401k didn't save Greg on taxes. It put the tax bill in a time bomb and gave him the timer. And this is where you should start to feel better, since the Mitchells aren't stuck. They have only to look at the map. And here is the map. The three options. Not to replace the 401k. After the game, anything beyond the employer match is better spent elsewhere. Actually, 3 places. And the math on each one is going to make the 401k look like what it really is, which is a product that was designed in 1978, and the financial industry never updated because the original version was too profitable to change. Number 1 alternative, Roth IRA. You put post-tax dollars in. That means you get no tax deduction today. And I know it feels like you're losing something, but this is the answer you get. Every dollar of growth in that account is tax deferred, forever. You pay no federal tax when you take it out in retirement. Most states have no state taxes. None. And here is where the Roth IRA is categorically better than a traditional 401k for anyone 45 and older. There are no required minimum distributions on a Roth IRA. 0. Always. The IRS can't force you to withdraw money. You can let it grow tax-free for the rest of your life and leave it to your heirs. Today, under the rules, your heirs will have to draw it down over 10 years, but they pay 0 income tax on the withdrawals. Now contrast that with a typical 401k, where your heirs inherits the tax bomb as well. If you're age 50 or older, the 2026 Roth IRA contribution limit is $7,500 per year, plus a $1,100 catch-up contribution, for a total of $8,600. $17 and $107 a month. Let's run the difference if Greg Mitchell, age 47, had been putting $717 a month into a Roth IRA at Vanguard in VOO at a 0.03% expense ratio instead of into his 401k at 0.76%. The same 7% real return over the 18 years. In the 401k, the fees devour about $61,000 of Greg's growth. The fees in the Roth IRA gobble up about $700. And the 401k balance is taxed upon withdrawal. The Roth balance isn't. The Roth IRA is a 2-for-1 winner. Lower fees and no charges on exit. After the match is recorded, the 401k doesn't stand a chance. No, show me the math to make it happen. It doesn't exist. So if you make too much to contribute directly to a Roth IRA, the phase-out begins at $153,000 for single filers and $242,000 for married filing jointly in 2026. You can still do what's called a backdoor Roth conversion. You put post-tax money in a traditional IRA and then convert it to a Roth. Conversions have no income limit. It's been legal since 2010, and the IRS has said so many times. One important warning. If you have some pre-tax funds in a traditional IRA already, maybe from a rollover of a previous 401k, then the pro rata rule will require you to pay taxes on some of the conversion. The fix is to roll that pre-tax IRA money into your current employer's 401k first, which leaves you free to do a clean backdoor Roth conversion. It's a step further. It was worth the 15 minutes. Option number 2, the HSA, Health Savings Account. This is the most tax-advantageous account in the U.S., and nearly no one uses it right. The HSA has what's known as a triple tax advantage. Nowhere else in the tax code do you find all 3 of these. 1. Donations are tax deductible. And if you do payroll deduction, they don't pay FICA taxes, which is the 7.65% Social Security and Medicare tax also. Even a 401k doesn't escape FICA. The HSA does. Number 2. The money grows tax-free, just like a Roth IRA. Number 3. Qualified medical expenses are tax-free. No income taxes, no capital gains tax. Nada. Tax-free in. Tax-deferred growth. Tax-free out. This isn't done anywhere else in the tax code. The contribution limit for family coverage for 2026 is $8,750 plus $1,000 in catch-up if you're 55 or older. And that's where it becomes a stealth retirement account. After age 65, you can spend HSA money for any reason without penalty, not just for medical expenses. If you withdraw for non-medical expenses, you pay ordinary income tax on it like you would with a traditional IRA. If it's for medical expenses, it's still totally tax-free. And the punch? An HSA has no required minimum distributions, no RMDs. Allow the money to grow tax-free for decades. You can use it for medical expenses in retirement. Fidelity says that the average couple at age 65 will spend about $315,000 on healthcare in retirement. That's $315,000 that you can pay with tax-free HSA money instead of taxable 401k money. The problem is you need a high-deductible health plan to contribute. Not everyone has one, though. But if you do, and you aren't maxing out your HSA before putting extra money into your 401k beyond the match, you're leaving the best tax deal in America on the table. Third option, the taxable brokerage account. This is the one that nobody talks about because there's no tax deduction, and there's no product that a financial advisor can sell you on this. But for people over 45, a taxable brokerage account offers 4 advantages over a 401k that are more valuable than any tax deduction. Number 1. No restrictions on investment options. You can buy any stock, any ETF, any bond, any fund, any REIT, anything. You aren't confined to the 20-fund menu that your HR department set up. So you can buy VOO at a 0.03% expense ratio and hold the whole S&P 500 basically for free. 2. No penalty for early withdrawal. If you need the money at age 52, you can sell and get it. No 10% penalty. No application for hardship withdrawal. No loan documents. It's your money. 401k penalizes you 10% and income tax for touching it before 59.5. Nothing in the taxable account charges you. 3. Tax rates for capital gains. If you sell investments you've held for more than a year in a taxable account, you pay long-term capital gains tax, which is 15% for most people. Some pay nothing. The maximum is 20%. Compare that to your 401k, where every dollar comes out taxed as ordinary income at rates as high as 37%. 15% compared to 37%. The taxable account beats the tax rate for every dollar of growth. 4. No required minimum distributions. No one forces you to sell. You choose the time. How much is up to you? You get to name the tax bill. The IRS decides when, the IRS decides how much, and the IRS controls the tax bill with a 401k. The trade-off is you don't get a tax deduction coming in. But if you're over 45 in the 22 or 24% bracket, that deduction is saving you 22 to 24 cents on the dollar today, in return for giving up control of every dollar for the next 30 years. That's a horrible trade. You're trading a permanent flexibility for a temporary tax break. And the 401k industry makes billions every year from people that don't understand how one-sided the trade is. Now let me take care of the 3 things you're really thinking about right now. First, my company's match is up to the full contribution, not 6%. If you're in a rare and really good plan, your employer matches all the way up to the contribution limit. Congratulations. Keep on maxing it. The game makes the math all different. But the Society for Human Resource Management says most employers only match 4 to 4.6% of salary. Most of your 401k contributions above that match threshold is unmatched. That's the dollars we're talking about rerouting. Second, but I need the tax deduction now. My taxes are too high. I know the urge. But let me reframe that. Today you're opting for a 22% tax break to avoid thinking about a potentially higher tax rate in 30 years on an account that will be 5 to 10 times bigger, that you will be forced to take distributions from on a schedule you don't control. You get a little discount now, but you pay a lot later on. This isn't tax planning. That's time buying, with a receipt. If you want tax relief now, contribute to your 401k up to the match, and then fund your HSA, which gives you a tax deduction and FICA avoidance, and tax-free growth, and tax-free withdrawals for medical expenses. You get a better deduction with better terms using the HSA. Third, this is becoming too complicated. I just want to put it in and leave it. I hear you. And the good news. The alternative strategy isn't more complicated than what you're doing now. You're investing in a 401k you don't understand, with fees you have never seen in investments you didn't choose, and building a tax liability you can't predict. The other choice is this. Contribute to your 401k up to the match. Max out your HSA. Fill your Roth IRA with a single S&P 500 index fund. Any leftovers should go in the same fund in a taxable brokerage account. 4 accounts, 1 fund, all automated. That's all. That's the entire plan. And it gives you tax diversification, meaning you'll have money in pre-tax, tax-free, and taxable accounts, so in retirement you can pull from whichever bucket keeps your tax bill lowest in any given year. That flexibility is worth more than all the 401k fee disclosures you've ever shoved in a drawer. I'll tell you why the system is the way it's. This is the part that should make you angry. The Revenue Act of 1978 created the 401k. It was intended to top up pensions, not replace them. But the corporations realized that it was incredibly cheaper to offer a 401k than to fund a pension. In a 401k, the employee takes all the risk of investment, all the fees, and all the tax consequences. The employer simply selects a provider, makes the connection, and exits. Every year, the 401k plan provider makes money on fees charged against your assets. The plan is a way for the fund companies involved to profit from expense ratios. The record keeper profits from administrative fees. The employer saves money by not having to provide a pension. Everyone in the deal is making money, not you. You get what's left after they all take their cut, and then you pay taxes on it. The Investment Company Institute says the financial advisory industry in the U.S. is about $30 trillion. That's a meaningful chunk of that 401k assets. If every American put their contributions above the match into Roth IRAs and HSAs, the 401k industry would lose billions in annual fees. It's not a conspiracy. That's why nobody in that business is going to tell you what I just told you. They make money while your money is in the system. They make nothing when you open a Roth IRA at Vanguard and buy VOO for 3 cents on the $100. The 401k supply chain has no financial incentive to tell the truth. And that's why the old wisdom hasn't changed in 47 years. This isn't a personal failure. You did what every financial wellness seminar, every HR onboarding deck, and every well-meaning boomer relative told you to do. You hit your 401k max. And for the employer match part, that was right on. On top of the match, you were racking up a tax bill in a locked account with few options and hidden fees. The only reason it felt responsible is because the people benefiting from the setup wrote the brochure. Here's what you do. Today. Not next quarter. Not after you talk to your advisor who makes money when you don't change anything, by the way. Now, step 1. Log into your 401k portal and view the actual total of your fees. Look at the fund's expense ratios, administration fees, and any record-keeping charges. Sum them up. Multiply your balance by. That's what you're paying each year that you've never seen on a statement. If that number makes you squirm, good. It has to. Second step. Contribute to your 401k up to what your employer matches and no more. If they hit 50% of the first 6%, give 6%. If they match dollar for dollar on 3%, put 3% in. Get every free penny possible. Stop throwing unmatched dollars into a fee machine. Step 3. If you have a high deductible health plan, open an HSA at Fidelity and max it out. $87.50 for family coverage in 2026, $97.50 if you're 55 or older. Put it into FXAIX or some total market fund. Don't leave it as cash. Most people keep their HSA in cash, which means it's earning virtually nothing, and it's their most tax-advantaged account. If you can afford to, pay current medical expenses out of pocket, let the HSA compound, and save your receipts. If you later incur an expense that qualifies, you can reimburse yourself at any time in the future, even 20 years later. No time restriction. Step 4. Open a Roth IRA with Fidelity, Vanguard, or Schwab. It takes 20 minutes. You can contribute as much as $7,500 a year, $8,600 if you're 50 or older. Do a backdoor Roth conversion if your income is above the phase-out limits. Purchase an S&P 500 index fund. Fidelity 500 Index Fund, FXAIX, VOO, SWPPX, your choice. Configure automatic contributions. Doesn't exist. Step 5. If you have money left over after maxing the match, the HSA, and the Roth IRA, open a taxable brokerage account. Same platform. Ditto fund. No limits on contributions. No penalties for withdrawal. No RMDs. Total control. When you do finally sell, you pay 15% capital gains. That's less than the ordinary income tax rate you pay on 401k withdrawals. 6th step. If you have old 401k accounts sitting at previous employers, and the Bureau of Labor Statistics says the average American holds 12.9 jobs in a career, so you probably do, Roll them into your current 401k or into a Roth IRA, depending on your tax situation. There are 31.9 million forgotten 401k accounts in America with some $2.1 trillion. That's $2 trillion in accounts people have forgotten about. And they're still charging fees. Don't be one of those. Here's the urgency, and I need you to feel the weight of it. Greg Mitchell is 47 years old. If he starts today and puts every dollar of income above the match into a Roth IRA and HSA, then by the time he's 65, he'll have about $400,000 in tax-free accounts, in addition to his existing 401k. $400,000 that will never be taxed. It won't trigger IRMAA. It will never make his Social Security count as taxable. It will never be subject to RMD. It sits there, growing, silent, obedient, waiting for him to decide when or whether he touches it. And when he does, the IRS gets zilch. Compare that to another $400,000 inside the 401k, where the IRS gets, say, $80,000 to $100,000 in taxes. His Medicare premiums go up, his Social Security gets taxed, and the whole thing is on the government's withdrawal schedule, not his. Every year Greg waits to make this change is a year of Roth contributions he will never get back. The contribution limit for 2026 is $7,500. If he misses 2026, that $7,500 of tax-free room is lost forever. No carry forward. The years you miss you can't make up. The Roth IRA contribution window is use it or lose it. Every year you lose it, the tax-free part of your retirement permanently shrinks. There's a Greg who is 65 years old with $1.5 million, half in a taxable 401k and a half in tax-free Roth and HSA accounts, who strategically draws from each bucket to keep his tax bill near zero, his Medicare premiums at the standard rate, and his Social Security untaxed. That Greg gets to retire on his own terms, when he decides, and he decides how much. The IRS is an afterthought, and there's another version. Same $1.5 million, but all of it locked away in a traditional 401k. Greg sees the IRS take $150,000 or more over the first 10 years of retirement, sees his Medicare premiums skyrocket. 85% of his Social Security benefits are subject to tax. Why does his monthly income feel so much less than the balance should be? That Greg did everything by the book, by the standards of advice intended to benefit the person giving it, not the person receiving it. There are two people named Greg. Both futures remain on the table. The only difference is if he continues to follow the instructions on the box, or if he reads the ingredients list and sees that the box was never meant for him. The 401k isn't your foe. 401k up to the match is one of the best deals in personal finance. But the 401k beyond the match? It's a commodity, especially after 45. Like any product, it was designed to serve the people who sell it. You just also happen to benefit, in part, on their terms, on their schedule, at their price. You deserve better than that. Roth IRA has them. The HSA has them.